Our YouTube Live, and this is just a chance for me to summarize what's going on with the Fed right now, given their monetary policy decision, but also for you to ask questions. So I'll very quickly summarize what happened, what the Fed said, my take on the press conference, which is always interesting, and then we'll go to your questions. So let's begin with the questions themselves from the journos who were there. Let's start actually with the decision. So no rate change. This is what markets were expecting. Very unusual for the Fed to do something which is surprising. And markets were expecting no change, and that's exactly what happened. And so rates are still in the 4.25% to 4.5% range for the federal funds rate. And I'd say that the overall economic summary that Powell came up with was an economy which is still in a pretty good place. So unemployment has been in the low fours for a while now. Low 4% is a good place to be historically. Inflation's been coming down. Now it's in the low twos, so it's not far off target. And the economy's been growing at about 2.5%, which isn't putting the world on fire. But look, for a developed market economy, the biggest economy in the world, that's pretty good, given everything that's going on. So I think if I had to characterize this press conference, it was as if we had a 19th century ship captain who is navigating in the fog, always a good metaphor for the Fed, and everybody's asking the captain, we've heard a storm's coming, what would you do if the storm hit? And we kind of know that a storm might be coming because of what's happening with the trade war, but we still don't really see the effects of it. So we've seen it on the pressure charts. We know that there's an area of low pressure heading towards us. So it's all a question of hypotheticals at the moment. You know, people are saying to him, what if this happened? What if that happened? And he was kind of saying, well, if this happened, that's what I'd do. So no absolutely clear effect yet of the tariffs. But remember, we're only 4 months into this presidency and 3 months into the trade war, or even less. So that's why economic data is kind of glacial. It takes a long time for the actual economic effects to filter through to hard numbers. So that still hasn't happened. So the Fed is still very much in wait and see mode. So again and again, Powell said that the three things, right? The scale, the scope, four things. Scale, scope, timing, and persistence of the tariffs is very uncertain. So until that becomes clearer, they're just going to wait and see. So they're in no rush in order to cut rates. Now, Trump today was joking. He was saying, oh, maybe I should nominate myself as Fed chair. Can I do that? You know, obviously he was joking. And it was actually pretty funny. But clearly he was calling for a 2 percentage point cut. You know, that's way away from where the Fed is thinking right now. So uncertainty, I'd say, is the thing that kept on cropping up again and again, as we've seen over recent policy meetings. That's been the kind of catchphrase for every central bank. The one worrying thing, I think, is that there was talk about going to a situation in which the two mandates of the Fed were pulling in opposite directions, right? So one mandate is to achieve maximum employment. So clearly, if it looks like unemployment is increasing, they'd be tempted to cut rates to stimulate the economy and to increase demand. But at the same time, if we've got inflation, then that's going to pull in the opposite direction because they want to raise rates to combat inflation. So if we do get these two different policy goals for the Fed, the two parts of their mandate pulling in opposite directions, if we have stagflation, then that's going to be a big problem. It's very difficult for a central bank to cope with that because it's not clear which way it should move. Now, what Powell said repeatedly was this is in their kind of guidebook for how their policy works. He said, it depends on how far you are from the target for both sides of the mandate. So are we way off the inflation target or way off the maximum employment target, in which case it becomes pretty clear which one you're going to go for. Also, you have to consider the lags for monetary policy to take effect, which would also factor into their decision. But those are the two considerations. And he said that they haven't faced that dilemma, stagflation, in a very long time. And they may still not face it. So again, we don't know whether that's going to be the situation which the Fed faces. But the probability of that, according to Powell, stagflation, has increased. It sounds like it's still not a central case, but it's higher. The cost of waiting, he said, is low. Big contrast to what Trump was saying today, which is, the cost of servicing US debt is high. And if the Fed cuts, of course, the cost of servicing the debt comes down, assuming yields come down. But I think Trump would actually do a better job if he kept his mouth shut about eroding central bank policy, because every time he does that, yields increase. If people don't believe in the central bank independence in the United States, then yields increase as government bonds sell off. So by just not saying those crazy things, he'll actually help with the debt servicing cost more, I think, than trying to suggest how monetary policy should be carried out, because it's not his job to do that. There were questions about hard soft data. So, the shock hasn't hit yet, was what Powell said. He said we see sentiment, we see people's concerns that higher prices may be coming or things like that. So people are worried now about inflation. They're worried about a shock from the tariffs, but that shock hasn't hit yet. So again, this soft, hard data conundrum. And there was also talk about debt sustainability. That's another big worry about the United States. And repeatedly, Powell has said something which is interesting, which is that it's not at an unsustainable level. So currently, if you look at the debt to GDP for the US, it's about 120%. But it is on an unsustainable path. What that means is, if the US government cuts spending by less than it cuts, so the revenue falls by less than, so the revenue decreases because it's cut taxes, but at the same time it's cutting spending. But according to the Congressional Budget Office, the cuts in spending haven't compensated for the lack of income from cutting taxes, or at least what's planned for the cut in taxes in this big, beautiful bill. So that means that the fiscal deficit is still large, and we're still adding to US debt to GDP. So Powell's point is that it's not too late. Currently, it is sustainable, the level of debt. They can still service their debt comfortably, given their tax receipts, but it's on an unsustainable path because it's growing continually, and presumably there will come a point at which they can't service the debt, which is many years in the future, but still an unsustainable path. So not too late, but worrying that there is this disregard, I think, from both Republican and Democrat politicians when it comes to fiscal deficits. And then there was a kind of follow-up question which got a laugh from a journalist. They said, do you think that politicians should take macroeconomic conditions into account as they look at this? And he replied, I don't think they need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy, i.e., you stick to your knitting and we'll stick to ours. So there was also a question about whether he'd remain on the Fed board until January 2028, because remember, he's going to be replaced in May of next year. So Powell's going to be, there'll be a replacement chosen again by Trump. Remember, Powell was chosen by Trump in his previous presidency, and he didn't really answer that question. He said, look, we're focusing on our mandate. And he also fobbed off any other questions about what Trump had said. Clearly, the Fed doesn't take into consideration what Trump says when it comes to monetary policy. It's very much based on the data that they see about the economy. So I think that's the kind of summary of the meeting. We did get an update of the economic projections, so let's just quickly look at that, because I think there were some interesting things there, and then we'll move on to your questions. I'm trying to keep it snappy tonight. So here's the, because it's very hot in here. still 29. Yeah, 29. 29 Celsius in here. So very hot. So this is the summary of economic projections. So this was updated at this meeting. Notice how the GDP projections have been downgraded since March. So down by 3 percentage points, 0.3 percentage points, not 3, 0.3 percentage points for this year, 0.2 for next, and 2027 hasn't been affected. Inflation expectations have been revised up, presumably due to the tariff impact, considerably for this year by 0.3 percentage points, a bit less for next year, and a tiny bit for 27. So clearly, if you have tariffs, it pushes up inflation, but it takes a year to fall out of the window, the price increases. But again, it's based on uncertainty, right? So currently we're looking at almost 2 cuts for 2025. Previously it was 2, according to the dot plots. Remember, each one of these is one forecast or one opinion about where the Fed's policy rate will be for 25, 26, 27 in the longer run. And it's not a forecast, it's just an opinion. But people put a lot of weight on these dot plots. So the median was 3.9 for this year, so that's 1 or 2 cuts. 1 cut for 26, and then 1 cut for 27. So a lot less cuts than we saw previously, given the fact that inflation is now expected to be higher due to the tariffs. And that's pretty much in line. So every morning of the Fed meeting, I take the snapshot of the market probabilities of what's going to happen. And now markets are expecting 1 cut in September, at the September meeting, 1 cut at the December meeting, and then 1 cut in March next year, and 1 cut in July next year. So 2 cuts next year, 2 cuts this year. So less. The Federal Reserve has got a less hawkish outlook than markets, which is always worrying. But I think this is more reasonable than it was previously, when markets were expecting cut, 2 cuts this year, 2 cuts next. I think this more leisurely pace of cuts is more likely, but still out of sync with what the Fed's going to say. Balance sheet still shrinking, and they're carrying on shrinking the balance sheet at the reduced rate. Currently it stands at about $6.5 trillion, just over $6.5 trillion. And that's fine. Anything else to point out? I don't think so. Yeah, you can see core PCE inflation has come down quite a bit, and it's not far off their target. But really, they're keeping rates where they are because they're worried about inflation just over the horizon, which is something they have to consider. Right, so I think at this point I'll stop talking and I'll hand over to Teddy, who's going to pop upstairs for some treats, and then you can think of some questions, hopefully. And if you are one of our if you do just do a super chat, we'll push you to the front of the queue. We'll answer your question first, and Laura will tell me. She puts it in a document so I can see that you've done a super chat. Here comes Teddy. He's going to get one of his burger snacks. These are super duper. Actually, they smell really good. I wouldn't mind one of these myself. It's like a mini burger. I don't know if you can see that. Ted, I'm not giving it to them. It's just showing them. Right, there you go. Yeah. Or if you're one of our YouTube supporters, we'll also push you to the front of the queue. And but we do appreciate if you do a super chat, because obviously it helps us financially, and pays for treats for Ted, obviously. So we've just been away for a holiday. We just went to Cambersands, so he's been in the sea. He absolutely loved it, didn't you? So do ask a question. Oh, and I should also mention that we, if you do join our membership, we've got a special offer where we've cut the first month's subscription by 75%. Just use the coupon SAVE75, if you want to join us, do join our membership. You can try it out, and you don't have to stay. You can cancel after a month if you want to. But anyway, yes, use the code SAVE75 at checkout, and that way you'll get a 75% reduction in your first month's subscription. And people do stick with us, so I think they do find the membership valuable. Primarily, I think, because it's a way of speaking with like-minded people. They're interested in doing it themselves, their own investments. They want to learn about investments. They want to learn about macroeconomics. They want to learn about gilts, government bonds, how yields are driven, all of the stuff that we talk about on the channel. But they can ask questions about it any time they want on our chat application. And they can also ask each other questions. And, we're doing a competition. I think we're doing it this week. Every 6 months, we vote on someone such that they can get a free year's membership because they're so helpful. So people can vote on other people for the most helpful pension crafter. So we do try and help one another, and people are generally very helpful. But if you do want to try it out, just go to pensioncraft.com/membership and use the coupon SAVE75, and that runs till the end of June. So you've got about 2 weeks of that remaining. So do try out our membership. We try hard to make it useful. We're always adding new features, and we do listen to what our members say. We've had a members survey, and a lot of that feedback has fed through into changes in some of our tools and what we do. So we do listen. Brilliant. So let's have a look at your questions. Let's have a look. Oh, Laura's typing something. Oh yeah, you'll find a link to that special offer for June, the discount for our membership. You'll find a link to that in the description as well, Laura says. So do have a look at that. Right, so let's go to your questions. Ed says, only 4 months in, seems like longer. Yes, I know what you mean. It's funny because we interviewed Katie Martin from the FT, and she was joking that it seems like, every article is about Trump and it just gets quite boring. So I can see that's going to be the case for another 3 years, 3.5 years at least. Any thoughts on who Powell's successor will be? This is from El Sabio. Well, I think it has been talk about Besant, who's currently Treasury Secretary. You do see people shuttling back and forth between the Treasury Secretary job and the Fed chair. Janet Yellen, for example, was one person who moved from the Fed to the Treasury, I think. Yeah, I think it was that direction. So maybe Besant will be a good person. I think he probably would be quite good. And I think the point is that once they get to the Fed, they are kind of protected by law from interference from politicians, at least at the moment. The law could change, of course. But Fed independence suddenly becomes a mantle which they take on. So even if the president tries to get someone in the job who he can manipulate, then I think that's unlikely to work, because the person who's in charge of the Fed would have all of this machinery behind him and all this precedent behind him and the will of markets behind him or her, such that they will remain independent. I think markets would take it really badly if they thought there was some kind of shoe-in for someone who would immediately cut rates, even if that was inappropriate for the economy. That would be a really bad look, and markets would take it very badly indeed. But hopefully that won't happen. But who's it going to be? Well, that was one of the thoughts. I'm not sure. I haven't actually read up on who else could do it. I just saw the Besant idea. But I think Powell was a pretty good choice. I think he's got a good. He's been a good chair. I really like him, and I'm going to miss him when he's gone. But there we go. I don't think Trump will. So Nick says, any super chats? No. Nick says, Hi Ramin, markets are back to where they were pre-Liberation Day. Well, yeah, okay, actually that's what you say. But global index funds are not. I take this to be a result of the weakness of the US dollar, as funds are skewed to US markets. That's exactly right. So if you look at the S&P 500, it's back to where it was. If you look at a global index fund, let's do that. Let's look at a global index fund. Let's use ACWI, because it is global. So this is the State Street global index fund, and it is global. So this is the fund. So the ticker is ACWI. It trades on the London Stock Exchange. It trades in sterling. So it's currently worth about £187. This is its graph of price. So still not quite back to where it was. It's down by about 5%. And if we overlay, say, the S&P 500, see if I can find it. Yes, it's right at the top here. That has recovered. So let's zoom in. Yeah. Can I see the S&P? No, I can't. S&P 500, I thought I added it. Oh, that's because I'm plotting total return. 1 second, I'll change that. Chart price. Okay, total return. Yeah, so not quite back to where it was, not far off. It has wobbled a bit recently, the S&P, but not far off the all-time high. Almost there. But it looks like it has weakened a bit recently because of, well, my face is in the way, sorry. Yeah, so the S&P is the blue line, the ACWI index, which is the global MSCI All Country World Index in tracker, that hasn't recovered. It's still down by about 5%, and that is currency. So if we look at sterling versus the dollar, you'll see how much that's been weakening recently. Oh, no total returns. So let's look at price. And we'll take away the S&P 500. If you can actually see it, good. Right, so this is, so GBP USD, if the dollar's weakening versus the pound, this line goes up, right? So that's what's been happening recently. There has been a bit of strengthening over the last few days, but overall you can see that there's been a 10% weakening, which for a developed market currency is huge, especially as at the same time US yields have stayed high. Usually it's interest rate differentials that drive these things. But what we've seen is US yields have increased at the same time as the currency's weakened, which is very unusual and very toxic. So that's the unfortunate position we're in right now. But you're right, that's why they haven't recovered. So this is why some people have been talking about currency hedging their US equity exposure, because that way they're not exposed to the dollar effect. Now, of course, it could go both ways, and that's why sometimes it kind of makes sense not to be currency hedged. Previously, it was a good thing, because if equity markets fell, sterling weakened, and it reduced the size of the fall for UK investors. So that dampened volatility, both on the downside and the upside. But that doesn't seem to be happening anymore. So that's unfortunate for UK investors. We get the double hit of sterling strengthening versus the dollar at the same time that equity markets are selling off in the US, which is a pity. Chris we do have a super chat. Thank you very much. Amir Kitobchi, he always joins us for these calls. Thank you, Amir. He says, indulge this off-piece super chat, but here's a tribute to Iran and the quiet strength of the Iranian people, where we ultimately belong. Peace. Yeah. So, yeah, unfortunately, there's not much peace there at the moment. But, yeah. So, obviously markets have kind of reacted to this, and I think that's one of the reasons why the S&P's had a bit of a wobble. I mean, if we do see a conflagration in the Middle East, and we see the US start to join into the battle, and then we see other proxies join, as has happened in the past, like Russia. This has the potential to escalate and get much worse. But war, nobody likes to see it, and the loss of life that goes with it, and the civilian casualties that go with it. That's tragic. So next question is on Chris Matthews. Please take a moment to clarify what audiences PensionCraft subscriptions are geared to. Are subscriptions most helpful when looking through a UK lens, focusing on ISAs, SIPs and gilts? Yeah, generally, 80%, Laura was telling me today, 80% of our, I think I might be on YouTube actually, 80% of our viewers are on UK based. I'd say the membership was maybe a bit higher, but a lot of the questions, so what we do every week, the viewers, the members, the pension crafters on our chat application, we have a special channel where they can suggest questions to which I make a video reply. And I call it a video explainer. And I've done about 260 of these over the years, but these are questions specifically asked by the members. So it's often the case that these are questions about UK tax recently. I don't know why, but that's what people are kind of obsessed with, rather than markets themselves. But there is more of a focus, I'd say, on UK investors than people elsewhere. But we do have members who are from the US, for example, from Canada, a lot of expats who used to be in the UK but aren't any longer. But there is a kind of tendency to be UK based. But look, if we had a popular question asked about anything else or another market, we'd probably try and do it justice. Yeah, we would. There's a question here again from Chris Matthews. Is there content focusing on retirement goals for US citizens? I'd like to underscore the distinction between covering US markets versus covering retirement strategies for US citizens. I'd say a lot of the ideas behind investing in the UK, the US, Australia, Canada, any English-speaking country are similar in the sense that you want to have a sustainable pot. You don't want to draw down too quickly. There are certain drawdown rules that you apply. Now, what varies between different countries are the tax rules. And also, for example, in the US, once you reach 75, you have to start exhausting your pot. You can't keep it. Rules like that, which are specific to the US. But, we don't usually get asked questions about that. But if someone did, on Mattermost, for example, our chat application, then if there were other US citizens present, they'd answer the question. So, I don't think I think a lot of the stuff is about investment and choosing funds, and that is fairly universal, the principles behind it. But we try not to be UK specific too much, but our members are primarily UK. Cyril says, I remember when the FOMC meetings used to move stocks massively. Now I didn't even know a meeting had happened. Yeah, it's like the Fed isn't important anymore. It's as if monetary policy just is not relevant. But I think the points where it is relevant are when there's a really big crisis. Those are the turning points, when the Fed steps in and they use their monetary tools and they do the kind of shock and awe thing where they buy everything and they use their pretty much unlimited balance sheet, which is now recharging itself, remember. They use that to stimulate markets, and you bet people listen when that happens. At the moment, I think we're in this position where inflation's kind of coming down to the 2% target, so it's a matter of easing off on the tight monetary policy, and that's pretty much understood by markets. It's really a question of how quickly it happens. Of course, Trump wants it to happen more quickly because that way his fiscal deficit won't be so painful. Servicing the debt won't be such a drag on the US economy. But they've got to be cautious about what the impact of tariffs will be. So I think that's why it's good we do have the independence. But look, I think I think the Fed is important, and I think the independence is important, and the way to find that out is to try and take it away, and hopefully that won't happen. But will it massively move markets? Usually that happens if they surprise markets. I remember in 2004, there was a surprise from the Fed. I think it was a surprise rate hike, and markets responded really badly. And I still remember the taper tantrum in 2011 when Bernanke was just talking about tapering, reducing the rate of asset purchases, and markets sold off. Treasury sold off, equity sold off. There was a huge furore over it because he had to be so careful with his messaging. And he just hinted that there was going to be tapering. He just mentioned it at one of the Fed meetings. And markets were desperate for this support at that time, because remember how bad things were. If you were around at the time, you probably remember how bad things were in 2009, 10, even 11. So just the hint that they were going to taper was a big shock. But yeah, I think we've been through all these rounds of shock and awe, and now we're kind of back to normalization. So it isn't so exciting as it was, but it's still important. So there's a question from El Sabio, who says, other than the price of oil, I think you mean, other than the price of oil, do you think an Israel-Iran escalation could have a big impact on global markets? Weirdly, no, unless it affects US earnings. And that's the primary thing, right? If it affects US earnings, corporate earnings, then yeah, it'll have a negative impact. If it affects business confidence in the United States, then yes, it could have an impact. Usually the effect of Middle East instability is on the price of oil. Now for the US, because they're almost self-sufficient, if not, I think they are self-sufficient now for oil, it's no longer the case that this is an input cost to them. Whereas for countries like India, countries like the UK, oil is a big input cost to the economy. To first order, the UK pumps in oil and pumps out services. And if the cost of the oil increases, then that just makes us less profitable as a UK PLC. Same for India. Whereas the US, not such a problem, because if the price of oil increases, it's actually helping a large section of the US economy in the energy production business, in the oil and gas industry. So ironically, I think this time around it actually helps the US if the oil price spikes. So I don't see an immediate negative impact of war in the Middle East, unless it looks like there's going to be things like worries about repercussions, about terrorism in future, that kind of thing. But again, this is very indirect effects, which probably wouldn't negatively impact US earnings directly, unless you're an airline company and people are scared to fly, for example, that sort of thing. But I don't think it would be necessarily negative, unless it spills out into a broader conflict, which draws in other countries like Russia, say, because then that could be really severe, because that could spill into Europe and so on, which could get very messy. Right. How are we doing for super chats? No super chats. Okay. Nice haircut, someone says. Tim Bird. How are you feeling about QYLP? Yeah. So QYLP, if you're not aware, is a covered call fund which sells upside calls on the Nasdaq and generates a high income as a result. Now, I used to own it. I don't anymore, but I sold it. Let me see if I can find the price of it. But the idea with this thing is that you sell the upside to somebody else because you don't believe in it, or just because you want to monetize the income. So this is the price of QYLP. You keep all of the downside of the Nasdaq. You've sold some of the upside, almost all of it, to someone else because in order to generate greater income. And as a result of that, you get a dividend of about 12% per year because you've sold these upside calls. But the price of that is if the equity market falls, the Nasdaq in this case, if the Nasdaq falls, you keep the downside. So for a while it rallied with the Nasdaq. It just depends on when the call options are struck about how much upside you get. But you had a bit of a rally from about £13 up to about £14.60, and then we got this big fall which was down about 20% from January to when was that? That was June, so that was yesterday. It has rallied a bit since then, but not a lot. But yeah, but it's still the case that it's paying out this fat dividend. But the dividend, remember, will always be a percentage of the price of the fund. So now you're getting a smaller dividend than you did by the amount that the index has fallen, so 20%. But I sold it before the big sell-off, fortunately. So I didn't suffer the fall. But look, if you're going to hold this thing for a long time, what you learn is the total return. So let's have a look at the total reinvested total return for this fund. So suddenly it's not looking so bad because of that income, which is going to make it recover more quickly. But it's still the case that you keep the downside. So that's the price that you pay. And if something seems too good to be true, there will be a catch like this, right? Which is that if the Nasdaq falls, then you're going to suffer the downside. But to be fair, you know, it is recovering. So until the Nasdaq falls again, of course. And of course, you'd be better off just owning the underlying index long term. And that's what people often forget. They get kind of caught up in the financial engineering. They get excited when they see a 12% dividend. And the kind of environment in which it's best to buy these covered call funds is one in which the market's either moving sideways or down slowly. Because down slowly is still okay. You'd still be better off then than owning the index itself. But if the index is tearing upwards, well, just buy the index. You know, that's the thing. So usually markets go up, so that's why usually you're better off just owning the index and not kind of selling the upside, which is what you're doing here. But good question, thank you. I do like QYLP. How are we doing for questions? 9:22, it's getting late. We'll just answer one more question and then we'll draw a line under it. Plasros says, love your videos. I always show Teddy's sections to my girlfriend. There we go, right. Teddy's a bit of a babe magnet. SP Luger always calls him Bubby. I don't know why. He's Teddy. What's the credit risk of Vanguard's Sterling Money Market Fund? What if creditors default? So that's the last question. So it is a money market fund. The good thing about Vanguard's money market fund is you can actually see what's inside it, whereas with other ones like CSH2, you can't actually see inside the fund because it's a total return swap and it's actually the counterparties that own the assets and you can never actually see what they are. So let's just pull up money market fund. Here we go. So this is the fund in question. This is the Vanguard short-term money market fund, and you know it comes in two flavors: accumulation and income. The income version is always worth £1. It just throws out dividend payments every month. So these are the distributions. And those add up currently to about 4% probably, whatever SONIA rate is, the Sterling Overnight Index average. Now, the accumulation version is the one that kind of smoothly increases because you reinvest the income. But the one we're interested in is the portfolio data. So firstly, you're not taking much duration risk. The weighted average life of the things which it owns is 41 days. There are 11 issuers, so it is diversified amongst issuers. One of those issuers is the UK government. So UK Treasury bills, so that's the UK, make up half of the overall fund. No thanks, Vanguard. Time deposits make up 32%, so these are deposits with banks presumably. Commercial paper, these are loans to companies, these have credit risk, and of course cash doesn't. So this is the portion which has credit risk. I guess you could say this does have credit risk as well for UK banks or other banks. You can actually see the individual issuers, so you can download all of the holdings. 10 main holdings make up 61% of the fund, but you can download them all and you can actually look at the counterparties, but they will all have high credit ratings. You can guarantee that, and there'll be Rabobank, for example, or this bank from Frankfurt. So what is the credit risk? I think it's very low, the risk of default for any one issuer. It's not the kind of situation where a fund has 30% of its commercial paper in one issuer. That's not the case here. But you can always download the individual holdings, and if you're not comfortable with them, don't buy the fund, is what I'd say. But overall, I'd say the credit risk is pretty low. By design, of course, that's the whole point of money market funds. But it's not zero, which is why you get a yield pickup for having that commercial paper in the fund itself. Anyway, so look, let's draw a line under it there. No Fed move, so the Fed's still in wait and see mode. US economy is still in pretty good shape, so pretty good news stories there. And we're just waiting to see what's going to happen to the data in the future, and the Fed's going to be driven by that. So anyway, thank you for joining us. We'll be doing this again tomorrow at let's see what time it is. 6 o'clock tomorrow. We're doing a live stream on the Bank of England, so all over again, and the temperatures will be a little bit higher than they are tonight, so I'll be sweating even more at that point. Anyway, thank you for joining us, and we'll speak again tomorrow.